A 40-point difference in your credit score could cost you over $300 per month on your mortgage. That's $108,000 over 30 years. And most buyers don't find that out until they're already under contract and it's too late to fix anything. So today we're going to get ahead of it. I'm Candy. I'm a mortgage loan officer, and I work with first time home buyers every single day. And the two things that I hear the most are one, my credit isn't good enough. And two, I don't have enough money for a down payment. So today I'm breaking down both of those things. And I think you're going to leave this video feeling a lot more comfortable than when you started. If you feel like this is helpful, please subscribe. I post regularly and this channel will save you money. So, how are your credit reports used by the lenders? First off, we pull all three of the credit bureaus, which are Equifax, Experian, and TransUnion. We take the middle credit score out of those three, and that's the one that we use to set your terms. If you have a co-borrower, if there's more than one of you, then we're taking the middle score for both of you, and then we're using the lowest of those two middle scores. One of the questions I get a lot is, what does my credit score need to be to qualify for a loan? And that really depends on the type of loan you're qualifying for. We will get your credit score, and from there, we'll determine, okay, this is the best loan option for you based on your credit score. And sometimes there will be more than one, and we have to look at which one fits your needs based on all of the other information on your credit application. First off, when it comes to FHA loans, these are the most lenient when it comes to credit on traditional financing. We're looking for at least a 580 credit score, and that's to put down the minimum of 3.5%. You're going to have a much better time of it if you have a higher credit score, though. So 620 is a good sweet spot, but we can usually do it with at least a 580 credit score, depending on everything else. Your conventional loans need to have at least a 620 credit score. They've changed that recently so that you can go down lower, but we're looking at between 680 and above is going to be the best fit there. A VA loan. VA does not have a credit scoring requirement, but you'll usually see that you have the best time of it if you have a credit score of at least 580 to 620. And USDA is usually best at about a 640 credit score. So you may be looking at your credit score on Credit Karma or MyFICO, or your credit card company may have an app for that. And those credit scores are valid, but it is a different credit scoring model than we use in the mortgage industry. When you get your credit score for your mortgage, you may see a big difference between your Credit Karma score and the score that you're getting from your lender. And that's because they're just different credit scoring models. I always like people to use a credit monitoring service like Credit Karma or MyFICO or something like that, because it will at least tell you what direction your credit is moving. I'll have some people say, oh, I've heard that Credit Karma is not a good credit score. And that's not true. It's just a different credit score. But what you're really looking for is, are you seeing the movement in your credit score that you want? So if you're trying to improve your credit, then if it's improving on Credit Karma, it will also be improving on your mortgage credit score as well. Keep that in mind and keep monitoring that. What are the things that impact your credit and how can you move those? There are five things that have the biggest impact on your credit. Number one is your payment history. It's really looking at how well you pay your bills. Do you have any missed payments, late payments, charge-offs, collections? Any of those will have the biggest impact on your credit score. And we're looking at the things that are the most recent. So if you have something that happened, 5 years ago, that will have a lot less impact on your credit score than something that happened last year. And really the last 2 years, I find, has the most impact. Once you have a late payment or you have a collection, that stays on your credit for 7 years, but you will see that your credit score will improve the further you get away from that, all things considered. The second most important thing that a lot of people don't even realize is credit utilization. And this means how much of your available credit are you using? And when we're talking about available credit, that usually means like lines of credit such as credit cards. For instance, if you have $5,000 in available credit, meaning that maybe you have 5 credit cards at $1,000 each, a total of $5,000 available to you. You really want to keep the balance on that aggregate limit under 30%. So on $5,000, you want to keep your balance on that under $1,500. We don't want it to be zero, but we don't want it to be over 30% either. That's usually the sweet spot. The closer to zero, the better. So if you're getting ready to get your credit pulled for a mortgage, then about 30 to 45 days before that, if you can bring down those balances as much as possible, not to zero, that will probably be the best situation for you. One of the things that a lot of people also don't realize is how old your history is. This is your length of your history. It's about 15% of your credit score. And this means that if you have credit cards that are 20, 25 years old, if you close out those cards because you're getting a better interest rate somewhere else, you may actually see your credit score drop. And that's because the age of your credit or the history of your credit is now shorter. You just replaced a 20-year-old credit card with a brand new credit card, and you will see that that does impact your credit. It's always a good idea when you have those opportunities to move balances over to a new lower interest credit card. Go ahead and do that, but don't close out the old card because that's part of your credit history. Use it occasionally. You don't have to use it a lot, but make sure it stays open. We also have your inquiries. And this is one of the things a lot of people do know about. Don't have your credit pulled a lot because that impacts your credit. It's about 10% of your credit, so it's not a huge amount, but you do want to be cautious about not just having your credit pulled everywhere. So you want to open a department store credit card, you can save 10%. And I'll have some people say, I do that just so I can save money and then I close it. You're getting new inquiries on your credit, you're getting a new account, and then you're closing that account right away. It's probably not worth it for the savings. So those new inquiries are not a great idea, but it doesn't impact you as much as you might think. And then lastly is just your mix of credit. This is something you don't have a whole lot of control over. You have the credit that you have, but what they're looking for is a variety of account types here. It's about 10% of your credit score. We're looking for installment accounts, lines of credit like credit cards, and mortgages. So if you have all of three of those, you have the best mix of credit. If you don't have a mortgage, obviously, then you're not going to have that great mix of credit, but there's not much you can do until you do have a mortgage. Don't want anybody to run out and get a new installment loan just to fix the mix of credit. That's about 10% of your credit. In the long run, that's not a real big part of it. What are some things that you should not be doing right before or during the mortgage process? Typically, your lender will tell you, hey, these are the things I want you to watch out for once we're under contract. But you should also look at these before you even go under contract because we're looking at your immediate history on your mortgage application. No new credit cards or loans. Try to avoid any new accounts, any new accounts, especially during the process, but immediately prior because nothing shows up on your credit report typically for about 30 days, 30 to 45 days before a post. We don't want any surprises. So we don't want you to have bought a new car a month ago that didn't show up on your credit report and suddenly it shows up and now we have to count it and it's a surprise. No large unexplained deposits. If you sell a car, for instance, we're going to ask you for documentation of that. If you do have to make a large deposit, ask us, what do I need to do? I'm about to put some money into my account. I just sold my car. What do you need? If you're getting a gift, then there are very specific requirements for gifts. So we need to know where that money is coming from if you are making a deposit into your bank account that will be used for the purpose of the loans. Worst case scenario is that you deposit that money and then we can't use it. So if you were planning to use that money for the purchase of your home and we can't explain where it came from, then we'll have to treat it as if it does not exist, and we don't want to have to do that. Don't change jobs immediately prior or definitely during the process. Sometimes I know this is something that can't be helped, but if you can avoid it, don't make those moves while you're planning to buy a home or while you're buying a home, especially if there will be a change in your income. And I say this because sometimes you'll be moving from a salaried position to a position that has a variable income like commission. You know you're going to make more money in the new commission job, but we can't prove that. So it's really important that if that is the plan, talk to us so that we can explain how it works and what is the best way to handle that. Do not co-sign for friends or family on any loans before or during the process. If your kid is getting a car and they need you to co-sign, that is now your responsibility because if they don't make that payment, you have to, and we have to treat it as such. So we don't want you to have any additional debts come up that we weren't expecting. Don't miss your payments. Even one 30-day late can drop your credit score significantly. Make sure that you're really watching your credit during this process. So let's talk about down payments. First off, there is a really outdated myth that there is a 20% requirement for a down payment. And I know that there are definitely some financial people out there who say you really shouldn't buy a house until you have 20% down. But honestly, a lot of people that I come across will never be able to buy a house if they can't do it until they have 20% down. There are lots of ways to buy homes with lower down payments. That 20% used to be kind of the norm. And then we came up with FHA loans, and then conventional loans came up with ways to help people to buy homes with a lower down payment. So we have a few real options that are much lower than that. First off, we're going to talk about zero down options, and those would be VA loans and USDA loans. If you are eligible for a VA loan, that is by far the best way for you to buy your home. Zero down, great interest rates, no mortgage insurance. USDA loans are awesome. They allow you to buy a home with zero down. You do have to meet an income requirement, which is pretty generous, and you have to be in a certain area. This is typically going to be outside of the city limits. This is for residential homes, but it is intended for areas that are less populated. Then on the conventional side, we have 3% down loans. So 3% if you are a first-time home buyer, or if you meet the income limits. The income limits are pretty stringent, so we can take a look at those and tell you if you qualify for 3% down on a conventional loan. Again, those conventional loans do typically require a bit of a higher credit score, but it is a great option if you are a first-time home buyer, meet the income requirements. This is a great way to go. FHA is typically what most people think of when we think of first-time home buyers because the down payment is 3.5%. So it's still a really low down payment, and there's a little more flexibility when it comes to credit and debt to income ratio. Typically, on a conventional loan, you'll see requirements for 5 to 10%. If you are not a first time home buyer, don't meet the income requirements, you can still buy with 5% down. So that doesn't mean that you have to come in with 20% down on a conventional loan. Now, you will have mortgage insurance on those conventional loans if you're putting down less than 20%, and that mortgage insurance decreases the more money you put down. But this is a way for you to be able to buy a house and for the mortgage company to protect themselves. On a conventional loan, that mortgage insurance goes away once you reach a position of 22% equity. On an FHA loan, that mortgage insurance never goes away as long as you have that loan. So that's always one of the things that we're keeping in mind when we're looking at the type of loan that you should be getting. There are down payment assistance programs too. So if you don't have enough money for even the 3%, there are programs out there to help you with that. If you don't need it, we don't want you to use it because it will be a higher interest rate. But if you need it, if that's what it takes for you to get into a home, then let's go that route. There are lots of state programs, a lot of lenders offer these type of programs as well. One of the things that people don't think about when they're ready to buy a home are seller concessions. Buyers can negotiate for the seller to pay some or all of their closing costs as part of the contract, and that can help you to get into the house with less money. We'll usually provide you with all the numbers. This is what it is with your down payment, your closing costs, your taxes, and your insurance. But with a lot of my buyers who don't have a lot of money to put into it up front, I always tell them we're not looking just for the right house, but we're looking for the right sellers as well. When should you start this process? I really love for my buyers to start looking at 6 to 12 months out from when they're ready. So if you're planning on buying a house next summer, you should be planning right now. If you don't have that much time, then at least 90 days for you to really start planning ahead. It gives you time to take a look at, okay, do I have any large deposits coming up? Is there anything I need to do on my credit so that I can make sure that we're as ideal as possible going into this? What do you need to do right now if you're ready to go? Pull your free credit report. You can go to annualcreditreport.com, pull a credit report every week from each of the credit bureaus. It will not give you your score, but you can see a lot more detail than, say, Credit Karma about what might be dragging down your score. You can look for those high balances to your credit limit. You can look for late payments. You can look for mistakes on your credit report. Make sure those are taken care of. Have a pre-qualification conversation up front. Let's talk about what your plans are and when you will be ready. If somebody says, hey, it's April right now, I'm looking at buying in September, what should I be doing right now? Then I want to look at your credit report, and it could be the credit report that you pull from Credit Karma or annualcreditreport.com. Send it over to me. We'll take a look. These are the things that I want you to work on right now. How much money do you have saved? Where's that money coming from? Do we need to use down payment assistance? Do we need to ask for the seller? Is there anything that you can do to start supplementing that savings account? right now. Those are a lot of the things that we're going to talk about up front to get you prepared 2, 3, 4, 6 months, 12 months out if we can. So if you're watching this and you're thinking, I might actually be closer than I thought, that's exactly what I was going for. If you have any questions about your specific situation, DM me. I'm always available to help.